what goes on in bond markets, I think, is probably one of the biggest things that would keep me awake right now. We've just come out of the second quarter, and I think only a couple of days in, we were off 12% on some of the major indices. So for everything to have finished, I mean, the US, Wall Street's just had its best quarter since 2020.
Yep.
I think Nasdaq up, 10 and 3/4%?
Yeah.
I mean, just amazing. In 1971, when America came off the gold standard, it took the typical blue-collar American worker 12 hours to earn enough to buy an ounce of gold. It's now 105 hours. And even at its sort of toppiest moments in the past, for example, 1990, it was only about 90 hours then. So on that, I mean, it's a bit of a crude measure for judging the gold price. But on that measure, you'd say, well, it's well and truly up with events. How much further can it go?
Now, have you ever seen anything like this before, this kind of turmoil? Because I certainly haven't.
You mean in the media industry or in the markets?
Both.
In the markets.
It's fascinating. I mean, we've just come out of the second quarter, and I think only a couple of days in, we were off 12% on some of the major indices. So for everything to have finished, I mean, the US, Wall Street's just had its best quarter since 2020.
Yep.
I think Nasdaq up, 10 and 3/4%?
Yeah.
I mean, just amazing. Yeah, it's just...
All-time record on Friday. Extraordinary.
Yeah, great for volatility. I mean, for people who trade the volatility, it's fantastic. Well, you look at where gold has come from. So, I mean, we're nudging sort of $3,000 an ounce now, aren't we? I mean,
yeah.
the sort of cost of production for most of the big boys around the sort of barracks of this world is around sort of $1,400-1,500 an ounce. So there's already quite a premium built in. I was looking at some research from my old mate Russ Mould the other day, and he was making this point. He said in 1971, when America came off the gold standard, it took the typical blue-collar American worker 12 hours to earn enough to buy an ounce of gold. It's now 105 hours. And even at its sort of toppiest moments in the past, for example, 1990, it was only about 90 hours then. So on that, I mean, it's a bit of a crude measure for judging the gold price. But on that measure, you'd say, well, it's well and truly up with events. How much further can it go? Well, it obviously had that spike when Israel attacked Iran initially. It was funny. I was talking to a market participant the other day, and he just said at that moment, he said when it hit, I think it nearly went to $81 a barrel, didn't it? And he said I was shorting it all the way up at that price. Mm-hmm. And as soon as it broke above 71, I was shorting it because I think at some point it will revert back to the fundamentals, and the fundamentals of supply and demand right now is that the world is awash with crude oil, and the
economy's not great either, is it? The global economy, not great.
No, it's not. And even if you take Iranian production out, which is 3 million barrels a day, I mean that has a negligible effect. I think because the Saudis are pumping so much, America is now an exporter of crude. The world is awash with oil, and as you say, David, the demand is sort of fairly sketchy right now. So we're not as dependent globally, the economy, on crude as once we were.
I think one of the other things, I don't know whether it irritates you, but God, it gets me on my high horse. It's as we used to say in the old days, it gives me a dose of the pip, which is a chicken disease, in case you didn't know it. Is the fact is sanctions haven't worked anywhere around the world with Russia. There's always been a way out, hasn't there?
Well, except that the Russians are not price makers on their energy exports. They are price takers. So China and India, who we know are buying a lot of their output. I mean, the Chinese are getting a 30% discount. The Indians are probably getting between 20 and 25% of a discount. So yes, the stuff's getting out there, but the Russians are not making what they would be Paravis.
No, but on the other side of the coin, it also drags the official price down, probably from where it probably would be.
Of course.
We were talking last week, weren't we, about banks being a possibility.
I find this interesting,
yeah.
Ian, because banks languished really for about 12 years, and they were a pretty rotten investment, except last year, not before time, the likes of NatWest, Standard Chartered, Barclays bounced out of the traps because inflation had appeared, and because we had a proper interest rate flow. The states got their act together much more quickly because of TARP, I think you'll probably agree. Oh, yeah. But then this intervention by the Fed board last Wednesday, when they're going to say the capital requirements ratio to range between 3.5% to 4.5% from the current rate of 5%. Do you think they're getting behind the curve or what?
It kind of feels reminiscent of sort of pre-crisis conditions, doesn't it? When everyone was, I mean, I remember back in sort of 2006 going to conferences around sort of summer of '06, so just before that's probably when things were at their boomiest, their frothiest, I guess. So sort of summer of 2007, and I remember sort of people like HBOS saying that they were going to bring their Tier 1 capital ratio down to sort of 5% or whatever, and people were saying, RBS have done 4, you know, what's your problem? You know, surely this is capital that you should be dishing out to the shareholders, and we know what happened next. So is that sort of pro-cyclicality creeping into US financial market regulation? Maybe. I feel very sorry for Powell. I think he's doing as best he can with all the noises off from Trump. I think I forget who said it the other day. I thought it was a really good piece of commentary. Someone said at some point the Fed's going to have to decide between inflation and full employment. I mean, these are two different horses to ride. And, you know, if you studied your economic history back in the 60s and the Phillips curve and all the rest of it, you see where they're coming from on that. With the UK, if I were on the MPC, I mean, this is a controversial view and I'll be roundly abused by it, but I wouldn't be rushing to cut interest rates.
So you're more on Andrew Sentence's style.
Very much so. You look at wage inflation. I mean, it's more than twice the Bank of England's target rate. You look at core inflation. You look at services inflation. All of these measures are really not what the MPC wants to see before it can go ahead and cut rates. What goes on in bond markets, I think, is probably one of the biggest things that would keep me awake right now.
The biggest cumulonimbus clouds, isn't it? I agree with
you. So global debt issuance now is what, $335 trillion, something like that. 35 trillion of that is US denominated. Trump's going to be adding 2 to 3 trillion with his big, beautiful bill. Other countries, I mean, the UK, we're probably, you know, we've got a debt to GDP, debt to GDP ratio now of 96%. I mean, it would have been over 100 had Rachel Reeves not tweaked the definition of what constitutes the national debt. We're probably in the UK at the sort of pushing up against the limits, I think, of what we can probably borrow without markets being nervous. And you saw in the wobble that we had in US treasuries fairly recently that people are even prepared to test the treasury market with that. And I think that's quite nervous. As I say, I think the ECB was quite smart on this in terms of how they've handled their QT program. I think it's certainly something that must be agitating the Bank of England right now. Do you carry on selling down the bank's bond holdings in the way that they have been? Why wouldn't you? I don't understand why you wouldn't hold them to duration. Personally, I'm fascinated at the fact that there has been this sort of shift, you know, this move away from long dated assets, long duration treasuries to shorter dated assets. I think the UK's in quite a decent position here because, you know, the maturity of our
debt office has always had a very good reputation, though, Ian, hasn't it?
Oh yeah, they were absolute heroes, and they certainly were during that whole period of QE when the bank was expanding its balance sheet. You know, I think the average UK maturity is about 13, 14 years, which is further out than some of our peers.